Stay tuned for Retire Your Way with Dale Sudis, a leading financial retirement strategist and the founder of Sudis Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Sudis. That's right, California. Welcome to Retire Your Way with Dale Sudis of Sudis Financial. He is a retirement planning specialist, a financial advisor, and here to help you with retirement planning strategies, income strategies, tax strategies for you. I'm your host, Mike Spangle. Mr. Dale Sudis, what's on your mind this week?
Well, you know, we talk a lot about putting together maybe an income plan for retirement, or how to keep up with inflation or taxes, these various things. But, you know, it's interesting because I get it regularly where people say, you know, I had a couple a week or so back. They don't have children. You know, they would like to spend all their money and maybe spend the last dollar the day they take their last breath.
Yeah, and maybe even bounce a check for a couple $100 on the way out, right?
Okay, I haven't thought about that one, but yeah. But, you know, in other words, there's some, even if they have children and such, that's not their main priority. It's not how much we can leave to the kids and grandkids. It's, you know, we don't want to run out of money. I get that. But what if something happens to us and we still have assets, you know, money, investments, properties? Where do you want it to go? Do you want it just to go to the state and they decide? Do you want, you know, who gets it? And many times people don't think about how to simply correct that problem to make sure it goes where they would want it to go, whether it's children or charities or whoever.
I would even say that if you are single listening to the program here in California, wouldn't you like to have some sort of estate plan? You've worked hard, you've organized, you've taken care of whatever your assets are, your home, your car, your collections, and especially those investments. And if something happens to you that happens sooner than you expect, wouldn't you like to know where that's going to go? Wouldn't you like to have a plan for it? Even if it's your church, your synagogue, a school, friends, donate.
Pet charities.
Pet charities. I've heard of this. I definitely have. You know, we hear about if somebody gets a pet later in life. Hey, I want to make sure that I've got a little tiny trust for Rex, to make sure that somebody takes care of Rex after we're gone, right?
Well, how about that? Or even outfits that take care of like no-kill shelters and other things that really work hard to take care of pets properly. You know, but it's not just about if you die, where do you want these things to go? It's also about if you're alive, but you can't handle your own financial affairs. Who are you going to have handle your money, your assets? Who's going to help speak up to the doctors and other medical staff for you when you can't speak for yourself? So it's not just about being dead. It's also having the proper documents in we call it your legal docs, so that ones can properly handle your financial affairs and healthcare decisions.
Well, can I ask you, as part of Retire Your Way and Sudis Financial, let's start at the beginning here, because estate planning is usually something people talk about at the end. We're talking about the investments and the taxes and all that. But since we are talking about it in the first part of your program here today, how much can you help people with the estate planning? Where do you come into the role?
Well, we don't set up any of those documents. We prefer to let their attorneys, or we have attorneys we can refer people to if they don't have one. That's something that the attorneys do. And, you know, if I do refer you to one of the attorneys we use, the attorney and us are not licensed the same. So we cannot share money. You know, we don't pay each other to send people to each other. That's not how we operate. I just want to make sure your legal documents will work and work properly for you.
Okay. Yeah. Yeah, and we've got all different kinds of assets, and it's really just, it is one part of the complete retirement plan, and want to make sure that it's one of those things. Now, let's talk about some of the legal docs that you were just mentioning there. Let's go through what is the difference between needing a will, having a will, who doesn't have a will, and who needs and doesn't need a trust. What do we need
What's
there?
the difference between the two?
Yeah, what's the difference?
Good question.
Thank you.
I wish I knew okay. So a will is simply something that you could put together for your personal items. You have jewelry, or you have some collections, you have tools. You can even say the cars go to whomever, So you can have that written up on a sheet of paper, signed and dated as your will. You can have the attorney include it in your legal documents. A will is, mainly for things of that sort. You don't typically use a will for your bank accounts or your investments or your retirement accounts. Those you can actually set up, specific named beneficiaries on to make sure that they go where they're supposed to go. But, jewelry, like I said, personal items, fancy furniture, whatever it is you have that you want to go to certain people or places, then you put it in a will. Now, let's say you have a house or you have multiple properties. Now, you could write that you want the house to go to the kids or whomever, but that's not going to happen because the property, and most properties, if your market value, now we're not talking about, well, I have a mortgage of 100,000, it's worth 300. So, no, we're not talking about the net value. We're talking about whatever the market value of your real estate. If it's at or above 184,000 here in California, that will trigger probate. Okay, so the will won't keep your property out of probate. Now, on my desk, I have a bowl of pens and I have a couple
Probate
Sharpies.
sounds like something terrible I've got to do at the doctor's office once I turn 50. What is probate?
It's like a root canal. How's that?
Okay.
I sent you to the dentist instead of the doctor. But, for instance, I have some Sharpies in this, bowl of pens on my desk, and I'll grab one. I say, now you could take this Sharpie and write, on the side of my house, you could write, put these kids' names, that's where I want the house to go. But to be silly, I could paint over it and write Dale, In other words, the Sharpie isn't going to dictate where your property goes. There's not a section like in a bank account, investment or retirement accounts and such where you list beneficiaries. You don't have that on a house or real estate. So you need a living trust. It's a fancy will. That's all a trust is. They outlive you, and it carries whatever you title in it, like your property, to your beneficiaries, whoever you name, kids, charities, or whatever. Okay, so that keeps it also a private family matter. It's not when your property goes into probate, then it's a public affair. Anybody can go down to the county clerk's office and pull up for a few bucks, make copies of your estate assets, and it's like a laundry line. Everybody sees what you have out on your laundry line.
For your own complimentary Retire Your Way review, call Dale Sudas of Retire Your Way and Sudas Financial at 833-856-1382. That's 833-856-1382.
So if we would like to keep our estate planning, if we want to keep our assets private, we don't want to only have a will, because that, as you said, over a certain amount, that goes into the court system, and then it's up for public knowledge.
Oh, we'll have fun with that in a second here. Yeah, I'll tell you how that works. But simply, the trust keeps it a private, yes, family matter. In a matter of weeks, you can transfer the property on to the beneficiaries or do whatever you want, what the trust says to do with it. But the trust dictates. It outlives you. You have a successor trustee. Some call them the executors. They're actually successor trustees who handle the trust assets. Now, let's say you're married and you and your wife own your home, and now you put your home in the Spike and Wife's living trust, okay?
Okay.
You and your wife are the trustees. You are the ones in control. So it doesn't change control by putting your property in a trust. Control stays in your hands. What it does, it outlives you to make sure it goes where you want it to go without probate. You don't want probate on your estate. And a good example is this one. When your property goes into probate, not only can people go and see what you have and then come into the court and say, Spike owed me money. Now it takes longer than the typical 2 years. And, if your property is worth $400,000, I'm guessing, but you're probably at 10 to 20,000 in probate, attorney fees, court fees, all that to get your property through probate. So that not only can people challenge that or claim against your estate, but when the judge decides who gets it, I actually had a lady years ago whose mother inherited $91,000. And when I asked, well, where'd it come from? Well, it came through probate. Well, who died? Her ex-husband.
Wow.
I'm sure that's where he wanted some of his assets to go,
I'm
to his ex-wife. So this couple I just saw a week or so back, they have no kids, but this is a second marriage and they don't have a trust yet. So I just asked them, well, it'd be okay if your property and all these assets go to, your exes, right? So
nice joke. How did that go over as silently as it did here?
it motivated them. Well, maybe we better set up a trust.
Nice.
Again, they don't have kids, but they have, loved ones and maybe charities they would like things to go to. But we're going to also need to know what does not go into a trust. What, why where we use trust mainly for real estate. Yes, you could put your bank accounts in the trust and stuff. You're still in control of them, but there's certain assets that do not go into a trust.
Okay. All right. So we've got that will. We've got whether we need a trust or not. There can be costs associated with that. But let's, as we say with many things, don't be penny wise, pound foolish. Maybe you do need a trust because you can kind of direct these assets and your choices from the beyond if you want to make sure they go where you want to, and the privacy. Being able to keep your estate and your funds private and avoid this thing called probate. Now, we're not sure necessarily yet if you need a trust. We know that just about everybody out there should have a will. But if you don't have any of that started and you're already looking at your retirement a few years from now, do yourself a favor, give us a call right here and we'll take a look at what you've got and see, is this an important part for you to start getting planning on right now? There's no cost for it either. 833-856-1382. You call that phone number, it's going to go to our secure line, and we will schedule an appointment for you at no cost. If estate planning is on your mind, and for us, estate planning just means, are you leaving money to anyone? Then give us a call. 833-856-1382. More with financial advisor Dale Sutis and Retire Your Way right after this.
Do you know how you'll generate income from your investments along with your Social Security in retirement? In our opinion, it's never too early to start the income planning process for your future. An income plan can help you work towards creating a steady stream of income to support you throughout your retirement years. Don't leave your financial future to chance. Take control today and start income planning for your retirement. Call the team at Sutis Financial so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. Call 833-856-1382. That's 833-856-1382.
This is Retire Your Way with Dale Sutis of Sutis Financial. If you would like help with estate planning, your investments, taxes, when and how to take Social Security, even your Medicare choices. Oh, that lovely Medicare enrollment season with all of those commercials pounding at you. But what are the right choices for you? We actually have a specialist in-house who can help you with that. But give us a call, 833-856-1382. That phone call right now will go over to our secure call center to set up an appointment for you. No cost for that. Dale, right now we're continuing to talk about estate planning. Isn't estate planning just making sure you got the right beneficiaries on there and, on those certain accounts and
exactly.
You don't have to look at that. Like, hey, you signed up beneficiaries 20, 30 years ago. You're fine.
Yeah, let's say you have, okay, that's a good one too.
Thank you.
But let's say you have checking, savings, CDs, you've got some stock, bond, mutual fund, brokerage account, you've got IRAs and such. If you name beneficiaries on those accounts, no matter what value, they're not going to go through probate, okay? So do they have to be in a trust? No. If you have the beneficiaries listed properly, it'll bypass probate. But see, what happens sometimes, like you just said, you set up beneficiaries, years ago, and things change. Unfortunately, if, let's say, you lose a child and they're still listed, what happens? It can complicate things. It's okay if you set up a trust and either you put the trust as beneficiary on checking, savings, CDs, and non-retirement accounts like regular stock, bond, mutual fund, brokerage account.
Okay.
Now, we'll come back to why we do not put the trust as beneficiary on an IRA, 401k, 403b, any of that type of money in a minute. But as long as you name beneficiaries, those accounts will go where you name them. But if you're keeping your trust up to date and making changes, because usually a trust says if you die and you got these kids, and let's say they're all married and they all have kids, if one of the kids passes away, then their share goes to it's actually called their share, or their children. So you got 4 kids, one of your children passes away, their 25% goes to their children, not to their spouse, but to their children. That's how a trust is worded. So that's nice. But when it comes to tax-deferred accounts, the question should be, well, why can't I have, my $500,000, $800,000 IRA going to the trust? It'll bypass probate and it'll go where where I've listed my beneficiaries, right? Well, here's the problem. Tax deferred money. So it doesn't just have to be IRAs and 401ks. It could be you set up, put $100,000 into an annuity with regular money, but it's grown to be worth $200,000. So you have $100,000 of tax deferred growth. All of your tax deferred, IRAs and 401ks, obviously that's all tax deferred. If that money goes to your trust, the trust is treated by Uncle Sam as a corporation, and everything above roughly $13,000 will be taxed at whatever the highest marginal rate is. And today it's only 37%. I say only because guess where it's going to be down the road? Likely a lot higher. So whereas if it goes to specific people, then they can take it over a time frame, even up to 10 years, to spread out that taxable amount over multiple tax years and pay at their lower, tax rate, not the 37%, because not too many are at the 37% of the children, let's say.
Okay. You know what? Can I ask you just a quick follow-up on that? I mean, yes, it's important to have the beneficiaries. I kind of joked about, hey, we did this 20 or 30 years ago. No reason to look back at them. That's a huge mistake. Not reviewing your beneficiaries, especially as your family has changed, whether you've gone through divorce or death, and just like a story you were talking about, because especially through divorces, you might be remarried now without kids, but you had kids from your previous marriages. What happens with your accounts if you don't review those beneficiary designations? You know where your money can go.
That's a good one. What if, yes, you are remarried?
Yeah.
I've actually seen this. And when I had people pull up their beneficiaries and they were, remarried, they still had their ex-spouse as the primary beneficiary because they didn't think to change that.
Yeah. And Dale, this went all the way up to the Supreme Court. I'm not kidding about it. It kept getting kicked up. And eventually what the rule came out to be from the Supreme Court is whatever name is on that account is where that account is going to go, even if you haven't remarried. And I think it even supersedes the will. It might even say in the will, all of my assets are to go to my brand new wife, spouse, partner. And even if somebody else was listed and named on that, it's going to go to that person who's on the account. Dale, do you have any experience with beneficiaries either squabbling over stuff or something where this happened where
they didn't properly list the beneficiaries primarily? One is just hitting me in the back of the head because it wasn't too long ago. It was like, okay, so I'm talking to him. He and his 2 siblings are to inherit what mom and dad left to them, property and accounts, and there's quite a bit there. And the property itself out in the Bay Area is worth a lot of money. But that was in the trust, no problem. But mom had an IRA and she died first. So dad went through and got that set up in his name and another account likewise. But what he failed to do, he failed to put any beneficiaries on those accounts.
Oh my gosh.
And then he died.
So
And
I know we're in a hurry, and I know sometimes the details of stuff are just boring, but wow.
But so those accounts have to go through probate. The house doesn't, but those accounts do. So, it's just a hassle, and it's going to be, a couple years before they actually see that money, and who knows how much of it, and, with probate systems. So you don't want to do that.
Can we dance over probate? What about titling the kids onto our assets to just make them owners, whether it's our
Good question.
investment accounts or the house?
Good question. So let's say, like years ago before my mom passed away, she had me on the checking account with her. And that way, in case something happened, I can still write checks and pay the bills. The checking account wasn't necessarily in the name of the trust. It was just in her name. So we could have, 2, 3, however many people she wanted on the checking account. Not a problem. But the adding kids on title of real estate, why might that not be a good idea? Think about it. You add your children on title, you love them, you trust them, you add one or more, okay? And they own it with you. Yes, if you pass away, the property goes to, they're in control of it. They have the property, no probate. But what if, the child has some type of legal or financial problem?
Oh.
Whose house is now in jeopardy of being lost to that legal or financial malady, right?
Oh,
so,
okay.
no, it's not a good idea. Plus, you bought the house for $50,000 a long time ago. It's worth, let's say, $500,000. Let's have fun today when you die, and because it's on, it's in your kids' names, and now they take it over. No problem, no probate. But let's say they don't want to live there, and none of them want to, keep it as a rental. They just say, let's sell it and split the profits. Okay. Well, because you put them on title under current tax laws, you gave them your $50,000 cost basis, which means now they sell it. Now they get to show Uncle Sam $450,000 of capital gains that they get to pay tax on. But if they inherited it through a trust, then they get a stepped up basis. So you die, it's worth $500,000. That's their new basis. So if they sell it, right away, basically, and they don't sit on it for a year or two and it gains more value. Let's say they sell it right away. Again, under current tax laws, they get a stepped up basis. So that $500,000 passes to them tax free.
Okay. All right. And for folks who are spinning around right now trying to follow all those numbers and rules and laws, we realize it can be complicated, and we'll let you know how to reach us. Folks, just do you have one child or nieces and nephews or just even a spouse? There's so many little tiny things to think about. When was the last time you reviewed your beneficiary designations? When was the last time you thought about, do I have an updated will if I have one at all? Do I need a trust? Do I want to trust? At what point do I have to have one? Were you thinking about titling the kids or titling yourself onto your parents' assets to help them out with it? Boy, folks, I know there's a lot of things we want to do because we want to help people, but make sure that you speak with a financial professional, right, Dale?
You have somebody at least look at it who specializes in looking at things that way, because it's important. I'll pick on a friend, and if he's listening, he'll know who I'm talking about. But a dear friend, Dingaling, he owns a home, and they have assets and such. But he does not have a trust, and neither do they, from what I can tell, have a financial power of attorney or healthcare directive. But let's just pick on the trust side. But they own a home. I said, no, you know this attorney. I've known him for 20-something years, and he's reasonably priced. You need to get a trust. And, well, no, we'll wait. And I go, well, what if something happens to you? Well, she's on title with me. What if something happens to both of you? You can't set up a trust after. It's like I get in a car wreck, I'm going to go buy auto insurance. Yeah, that'll work. So you need to have the trust set up ahead of time. And it just, what do you say? It's like I could have told my mom to do, hey, you need to update this and update that. which I did, and just have one person at a time act for you. But no,
Well, that's part of the thing, Dale. And I know you
she
put the
gets to decide. Yeah.
you put the information out there. Yeah, I mean, you've created an entire firm for this. You help people with retirement planning strategies, and not just the estate planning, of course, investments and taxes and how and when to take Social Security. But folks, our listeners out there, we need you to take just a little bit of action to be involved in it. And here's the thing: we know that from all of the kinds of topics and holistic retirement planning, it feels overwhelming, right? It's like, wow, I don't even want to think about it. I don't know how to do this. That's okay. That's what Dale is here for. Now, we've talked about a lot on estate planning, and our listeners might not believe we haven't even really touched the tip of the iceberg right now. So I would like to talk more about it. Let's do that again next week. We're going to cover more things like durable powers of attorney, healthcare directives. How do we set that up? Does that go then into the trust, or who holds on to that, or your financial advisor, and all of the ins and outs of that. But we'll put it to you this way. Don't be overwhelmed with your retirement planning. Feel free to reach out to us, or at least someone like us, but someone who does specifically retirement planning. Our number here, when you call it, goes to our secure line. It'll go into the office. We'll set up an appointment for you, and there's no cost for it. We'll talk about whatever you want to. 833-856-1382. Dale, I got to take a very quick break. Folks are going to listen to our message. We'll be right back.
What concerns you most when it comes to retirement? Is it the fear of running out of money, the uncertainty of market volatility, or maybe it's healthcare costs as you grow older? At Sutis Financial, we'll work together to develop a comprehensive retirement plan for you that is designed to help protect and grow your wealth while also aligning with your lifestyle goals. Call Dale Sutis of Retire Your Way and Sutis Financial at 833-856-1382 to learn how we can help you work towards achieving financial security and peace of mind in retirement.
This is Retire Your Way with Dale Sutis of Sutis Financial. If you would like to get your own written financial plan at no cost to you, because you are one of our valued radio listeners, just give us a call, set up an appointment. 833-856-1382 is the phone number. I also want to blow up Dale's emails this week. You can write him with your question if you want to. info@sutis.com. That's info@SOUTAS.com. Write Dale your question about income strategies and retirement. Now, Dale, we're talking today about mitigating risk, and I like the definition to mitigate. It's to make less severe, serious, or painful. So how do we mitigate the risk? How do you and your firm help make someone's portfolio less painful?
Exactly. Yeah, because there's times I've seen people and they're shocked at how much their portfolio dropped. I remember a couple of years ago, somebody came in and, it was twofold. One for his wife's long-term care to get money to keep her at home through some programs that we help people with. The other was his retirement because he just retired. And in a few months between when he retired until we were able to start working together, his account dropped, quite a bit. And I was scrambling to figure out a way to make that money, stretch and last. So, but we came up with a good system, and they're happy and they're doing well now. But to be, I don't want people all worried about their retirement. That's no way to be retired or to go into retirement. The big thing that we like to help people see is once you establish what you need to pay the bills and what you want to do the fun things, because you have all the money in the world. Remember that question?
Mm-hmm.
That's always a good one to keep in the back of your head, because I want you to be, again, thinking that way, because if you're holding back and I don't know it, then how can I build that into your plan that you really want to do all these other things? But once we dial in a solid income plan, then the other portions of their money easily can be at whatever risks they want to take. Because I have many people who love, as a hobby, playing the stock market. They manage their own money. Maybe not everybody wants to do that, but you don't have to tie all your money up for one purpose. If you have the income taken care of, your other sources of money, assets, can be, you could do other things with them without worrying about it affecting your long-term livelihood.
So almost like diversifying your portfolio strategy, that it's not just in the stock funds and the bond funds of your retirement accounts. You're saying maybe even different kinds of asset classes outside of stocks and bonds.
Right. I mean, there's a variety of alternative type investments that you got to keep in mind. The main three rules that most people come in, they don't know they want to tell me that that's what they have, but I ask them and they say, yes, that's what I want. Number one, they want their money protected. Number two, they want to be able to draw some income from it. And number three, if possible, make it grow, right? I mean,
Yeah, of course. I mean, those three things. But is there anything that does all of that together, or is it the combination of putting together the plan, which means you need different tools? It can't all be done with one.
Yeah, that's a good question. So think of the ones who have the same three rules. Those are the big endowment funds, like Harvard Endowment Fund.
Okay.
If you look at how they invest,
and you manage the Harvard Endowment Fund, right?
Yeah, it's one of the side jobs.
Just one of those little funds. So so these endowments, they have okay, I know we're kidding there, but these endowment funds, they have billions of dollars in them. Which, okay, this is just a sidetrack spike rant, which you'll hear every now and then. I like how universities get to increase their costs 14 to 16% a year, but then they've got endowments of billions of dollars. That's a conversation for another day. But anywho,
but see, they have the same rules. They want that money protected, those billions protected, number one. They do want to draw from them for their purposes, right? Mm-hmm. And they want to grow them a bit. And if you look at how they're structured, more than half of their investments are alternatives. In other words, they're not the traditional stock or bonds.
And may I ask you, Dale, what you mean by alternatives? What are those alternatives? You're not talking crazy stuff like
my deposit slip? No. No. Okay. Alternatives can be things like commodities, gold, silver. It could be real estate, like REITs. It could be limited partnerships. It could be life insurance. It could be annuities. It could be, there's a variety of things that they put money into. Again, instead of out Santa Cruz here has that, what's that roller coaster called? It's a Big Dipper. And, it's exciting. It's real big and you dive down. We've all seen those big roller coasters. Mm-hmm. But when you build in properly alternative investments, you're now on a kiddie ride. Now, it might seem boring, but think about it. You're retired. How exciting do you want your money to be, going way up and way down, or having, we want to smooth out the ride. And effectively, that's what happens when you build in these alternatives.
Okay. All right. So, and then someone like yourself, you're saying that you also have the opportunity to be able to use and utilize some of these kinds of alternatives to build a steady income stream, a consistent income stream. I can't say the word safe for compliance reasons, but reliable.
Yeah, the any of us can match what the big guys are doing in those endowment funds. We can all do the same today. It's much easier than even, say, 10, 15 years ago, let's say. It's easier to build a portfolio, build an income plan, a full retirement plan, using all the different elements out there. But again, people don't realize. They come in and, how much can I make on this chunk of money? It's not about how much you can make. I don't care how much you have. What about your lifestyle? How are we going to maintain your lifestyle? How are we going to, be able to do all the fun things you want to do? How are we going to keep you out of a nursing home? Once we have that solved, then let's look at things that, hey, we can make this kind of money, or we can, take this kind of risk or no risk. So there's tools out there that bottom line can go up, but have floors of zero when the markets drop. So there's some neat tools that people can incorporate.
Yeah. So when Dale is talking about alternative solutions, I want you to just think about what kind of selections did you have in your retirement accounts when you were saving probably stock funds, bond funds, maybe a target date fund, but there are even other solutions, and it can become more complicated. And again, it's like having a bunch of different parts to a car, but unless you know how to put them together, you just have a bumper and a transmission and a whole bunch of screws and a seat sitting on your driveway. And what Dale does is put that all together to give you an automobile, a vehicle, if you will, for your retirement. And if that sounds of interest to you, give us a call so Dale can put together all of those different parts and pieces and make sure you've got an income stream that you can outlive in retirement. Call 833-856-1382. That call is going to go over to our call center. So don't worry about, if you're driving around, just remember the phone number or have your passenger take it down, or call it as soon as you can, though. As Dale has been saying, his appointment book is filling up and more folks are coming in from the radio show. And it gets really busy. So if you're concerned about that right now, get in sooner than later. Call 833-856-1382. Or, especially this week, I want to blow up Dale's email. Write him with a question and say, I'd like to ask you about this. What do you think? Do I need to come in? Write him at info@soutas.com. That's info@soutas.com. Now, Dale, this is going to be a hard question here. How do I know if my portfolio is exposed to too much risk? And the reason why that's a hard question is, what do you know about me? And what do you know about the person who comes in for the first time? How can you tell somebody if it's too much risk or it's too little risk?
That's not too difficult to figure out. Basically, our process, if you came in, you would see it's simple. We do encourage you to bring your current and or projected income, such as Social Security, pensions, and things like that. We encourage you to bring your current statements on all your various accounts. Now, understand, I don't need to make a copy of any of them because most people don't have all those numbers memorized in their head. Sometimes they don't even know, I have this account. They don't know whether it's a retirement account that's tax deferred or just a non-qualified, as we call it, or an account of just after-tax money. So by having that information, it's good. We don't need account numbers. We don't need your Social Security numbers. The most personal thing I might ask a person is their birth date, so I can start calculating based on, their income, their retirement dates, and such. It's not a difficult process. To me, it's easy. But don't ask me to do what you do. I have people coming in, they're engineers, they do all kinds of fancy things, and I would really mess up that job if that was my job. But I do know how to do this. This is fun stuff for me.
Awesome. So folks, if you would like to get your own written financial plan and find out, number one, are you taking too much risk, and what is too much risk for you? There's no cost for our valued radio listeners to reach out to us, come in, make an appointment, and we'll run some reports for you. The only cost is the few seconds of time it takes for you to dial this phone number. 833-856-1382 is the phone number. That's 833-856-1382. Call, come on in so we can get you started on your own complimentary written financial plan for retirement with Dale Soutas of Retire Your Way, and more importantly, Soutas Financial, right here in the middle of California. Are there solutions to help us capture the market gains, but still protect against losses? Another way to mitigate risk. Is that too good to be true? We're going to ask Dale and get his answer when we get back, right after this.
Call Dale Soutas, financial advisor and retirement specialist, for your complimentary Retire Your Way review. 833-856-1382. That's 833-856-1382. Do you know how you'll generate income from your investments along with your Social Security in retirement? In our opinion, it's never too early to start the income planning process for your future. An income plan can help you work towards creating a steady stream of income to support you throughout your retirement years. Don't leave your financial future to chance. Take control today and start income planning for your retirement. Call the team at Soutas Financial so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. Call 833-856-1382. That's 833-856-1382.
Welcome back to Retire Your Way with Dale Soutas of Soutas Financial. I want you to blow up Dale's email this week. Please write him with your questions at info@ Soutas.com. That's SOUTAS.com. Whatever your question is about mitigating risk, wondering about your investment strategy. Are you in the right asset classes? Write Dale and see if he can help you out through email. More likely, we'll probably got to come into the office. And to do that, the faster way is give us a call. 833-856-1382. That's going to go over to the call center. We'll schedule an appointment for you. Dale, right before the break, I was saying, are there ways that we can mitigate the risk to protect our gains, not, also have to be exposed to losses? Is that a too good to be true kind of philosophy? Do you have any rubber meets the road, like real people you've been talking to about this recently?
Well, a lot of different people. Basically, yes, that is true. You can have tools that allow you to get some of the gains of the market and have a floor of zero, which means if the market drops, you don't lose a penny. It does sound too good to be true, but there are several types of ways to do that, several accounts. And there's a couple recently, about a month ago, that came in, and they're young. I mean, they're in their mid to latter 50s, and they'd like to retire. Him
Wow.
sooner than her, but still, how are they going to do it? Have they saved enough, was their concern. And as I looked at things, and we looked at some accounts where we can set things up, and in a few years we can turn on income from one of the sources, not using even very much of their assets, that creates guaranteed lifetime income for both of them. And once they do down the road and we're even delaying their Social Security till age 70. So they have enough that we can make things work for quite a few years and then max out their Social Security as well. So yes, there
Wow.
are definitely ways to
Did they have
protect their
tens of millions of dollars? How are they able to retire in their late 50s?
They both have their 401ks and some IRA money and other savings.
So they were
No.
good early savers.
They did pretty good, but I'm not going to say they had more than, let's say, 1.1 million liquid assets. It wasn't
gosh.
a
Okay.
gigantic.
So this was more about lifestyle, in that you looked at their kind of monthly income spending plan and you asked them the question, if you had unlimited resources, what would you want to do with your life? And you came up with a
Exactly.
plan, and they can't,
Yeah, and we
without
built
running
all
out of
that in.
money. Wow.
The other thing I like asking is, okay, what projects, like remodels of the home, or what other big purchases in the next 5-10 years, a new vehicle and various things like that should be discussed so we can build that into your plan, because you need a chunk of money. Or is it better to get a very low interest loan on a vehicle, let's say, and make the payments because we've got your income in such a way that the interest on that car loan will be a lot less than what you're typically making on your assets. So don't take away from your assets that are earning more to, pay cash for a car. So you say,
Now,
oh, it's mine.
this happens to be with this couple. I mean, you're not trying to say here on the radio that you can help everyone in their late 50s retire. But now here's the thing. Did he go back to work that next day, or the following Monday after you met with him, and go, okay, I'm going to leave work right now? What did he do with the information?
No. And you're correct. Not everybody in their mid 50s or so can easily just say, hey, I can retire. But, we've had our share of ones that, we pointed out, yes, you could retire now if you want to. And the nice thing is he goes back to work knowing he's not stuck. He gets to, he can say goodbye anytime, right? And
That's like
that's
a
okay.
different, lighter way to walk into work, right? That's like 50 pounds of weight off of your loafers when you walk in the door for work. You go, you know what? I'm here because I want to be here, as opposed to I'm here because I have to be here.
Exactly. It's like years ago, my wife and I were up in Sacramento to Old Town. And in Old Town, there's these little shops. And there's one with pillows and plaques and pins. There's sayings on all these little items, all kinds of goofy sayings, right? And my wife saw one plaque and she said, "That's you." So we bought it, and that sits on my desk.
Okay, now can you say it on the radio, or do we have to?
Well, I don't know if I could say it.
All right. No, we're
but
kidding. What is it?
Yeah, we can. But really, to get a better understanding of why or what makes that saying on my desk me is take a minute at our website, sudis.com, and there's a goofy looking guy, it's me, in a purple tie, and there's a short 4-minute video where I tell my story of what I went through as a baby on up. And the saying on the plaque is, not to spoil the ending for you, but everything's going to be okay. Now think about it.
Nice.
That's why I tell my families that I meet with, that's what I want for you. If you know everything is going to be fine, you can focus on all those fun, important things, family, grandkids, whatever, and not be worrying about your money, and with having that properly constructed retirement income plan can really make a big difference in our viewpoint. And again, that 4-minute video, I just had somebody look at this last week, and he emailed me back and he says, nothing's going to, or what is it? Nothing bad lasts forever, because that's the phrase that I came up with from a Diana Ross song, which she sang the opposite, but I made that my theme song, and it was nothing bad's going to last forever.
Oh, so okay. Hey, do you want to sing that song for us right here, Dale?
Oh, I think we ran out of time, didn't we?
No, I got 5-6 minutes left in the clock. I got you
no, I'm not singing the song.
You can even do the unabridged version if you want to. But folks, here's why we're talking about this today. But we want to make sure that you've got a plan. Now, Dale is not saying he can help everybody in their late 50s be and stay retired and be able to walk into the boss. But how about you see where you're at along the journey? Are you ready? Maybe you might be able to retire a little bit sooner than you think. Maybe there's a little bit more work to be done. But why don't you talk with an independent financial advisor who is kind of like going to see a financial doctor. And let's do a good review. Let's do a deep dive and see what it's going to take to retire when you want to, how you want to, with the choices that you want to, being able to live it the way you want to. And one way starts with a phone call. Yep. All you got to do is see, when you call Dale's office, it's 1973. And just give us a call, 833-856-1382. It's going to go into the call center, and we'll set up an appointment for you, dedicated to you, your family, your goals, your choices. Right, Dale? Or when you just give them a call, come on in?
Yeah, just give a call, because I think, wasn't it you? You're going to answer the phone, aren't you? And
well, not on the weekends. No, okay. Too many show obligations for the great Dale.
If they call
Sudis.
right now, can't they just talk to you?
No, because I got the board in front of me. I got all my toys. I got to make sure that the crowd is all excited for you.
Keep them happy.
I got to make sure that if you get off track,
quiet, numbskulls, I'm broadcasting.
That Mo gets you back. And I got way too much. I can't answer
you
the
have
phone.
Too many tools.
I got too many tools going on over here. And just to remind everybody, that's our closing bell. It is the end of the program here. Dale, what were you going to say as the bell rudely interrupted you?
As the bell tolls. Especially if a person, don't just wait until you're 5 years from retiring, or even, within 5 years, or even if you're retired, you should have things mapped out. Don't be running around and wondering if my money's going to last or not. Just take a few minutes, and it doesn't hurt. And a lot of people, I love being able to say, hey, you're on track, you're fine, keep doing what you're doing. Because if you take care of people properly, what happens. They tell other people to come pick on you. So, and that's a good problem to have. So we get still more referrals than from any other of our advertising sources, because they know how mean and ornery I am, I guess.
And folks, and he's just kidding around. Of course, folks, if you call the phone number here and you come on in, we're going to use plain language. We're going to explain it to you so you can understand what your plan and strategy would be. This isn't about sales. This isn't about pitching a product. For us, financial planning, it's a process. And maybe there are some adjustments that Dale can help you with. Maybe you're already doing great. Wouldn't that be good to know? Because if you are, there's no cost. So come on in, sit down with a retirement planning specialist, a wealth building specialist, As we talked about throughout today's program, how do you mitigate risk? One way to mitigate risk is actually having a financial plan, a written plan, a savings plan, an income plan, a strategy, a tax plan, estate planning, all of that. It's holistic. It is, and maybe it sounds like a lot, but we won't make it overwhelming in the office. Dale is going to take it step by step. So give us a call right here. Dale, I'm going to ask if you want to say goodbye to everybody before we leave, but I'm going to give out the phone number and your email again. It's 833-856-1382 for you to give us a call. 833-856-1382. We're wrapping up today's program, but you're not going to interrupt the show. It's going to go to the call center. You can go to Sudis.com if you'd like to see that video on Dale and more about what we do as a financial advisory firm right here. That's SOUTAS.com, or you can write Dale. As I've said all show, I want you to blow up his emails today. Write him this week and ask him a question. See if he can help you out online. Info@Sudis.com, SOUTAS.com. Dale, you want to say goodbye to everybody before we leave this week?
Now, let's just keep it going for another hour. Actually, I want them to think about, a lot of people are hearing this from quite a distance from Fresno, and you're welcome. That telephone, it could be a telephone appointment, it could be a Zoom appointment.
Oh, great.
You know, it doesn't have to be driving all the way to Fresno. It just, we've helped people up and down the state we've never ever met face to face who are doing wonderful.
Oh, fantastic. I love that. And you can do it by Zoom. It's the new world. I love it doing it by Zoom. Have you ever had a teledoc appointment yet, Dale? I love it.
No.
I've been sick a couple of times over the last couple of years. It's one of the positive things, I think, from the debacle of 2020, is that some things have gone virtual like that. And I've been able to speak with a doctor. They get back quickly through secure email portals. Same thing here. You can set up your financial advisor, and if it's a distance that you don't want to come and drive in, we can do it over the phone and we can do it virtually. Folks, that's going to be all the time that we have for Retire Your Way with Dale Sudis this week. Please give us a call. We want to help you with your retirement planning, whether you come on in or whether we help you virtually. 833-856-1382. For Dale Sudis, I'm Spike Spangle. We will be back again with more next week.
Certain alternative investments are often complex, speculative, and illiquid investment vehicles that are not suitable for all investors and are typically only available to accredited investors who meet certain statutory financial requirements. As a valued radio listener of Retire Your Way, Dale and his entire team of retirement professionals invite you to schedule your very own complimentary retirement plan review session that will last as long as you need them to. Then call for your very own retirement review session, complimentary for our valued radio listeners. Are you able to lower your taxes in retirement? Are you unclear about your Social Security, Medicare, investment fees, and risk, or how to produce guaranteed lifetime income so your lifestyle and goals don't have to be changed with the ups and downs of the market or taxes? Call Dale Sudis with Sudis Financial and be confident you can retire your way. Schedule your own comprehensive and complimentary retirement review session. Don't just live in retirement, thrive. Call 833-856-1382. That's 833-856-1382.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal and tax advisor to be sure a Roth IRA conversion fits into your planning strategies.